This is the one and only strategy worth learning. There is no easier and more effective trading strategy than this one. It's called the order block. Stick until the end of the video to learn how simple trading can be if learned properly. An order block is basically just an area of price where there's situated a large amount of resting liquidity in form of orders. Those orders are waiting to get absorbed into the market. So when we see the price trade towards into these order blocks, we would be expecting to see a more volatile reaction out of the order block. Now the key thing is properly identifying these order blocks so we can follow their reaction. So how do we actually identify an order block? We need to be following multiple actions and make sure we understand them in order to validate an order block. The first one is asking ourselves, where in the chart we can see an increasing and large volume in the market? Basically asking, where can we find a large candle with a volatile move that looks to be making a trend, or breaking a trend? That candle in this chart is this large candle that moved to the upside. From that one, we look to identify the final candle right before that impulsive upside move. And this candle is what actually defines the order block. Now, some traders use the last downside candle before the impulsive move to the upside. The reason I don't like using that model is because sometimes, if not most of the times, the order block will not have a downside candle before the impulse, leaving us with lost opportunities. The point of that order block model is that traders like to see a sweep of liquidity before the aggressive push. But we will soon find that most probably there already was a sweep of liquidity before that, so this order block model of the zone being the last candle before the impulse, I found it works better. So we have now identified the order block. Now to validate the order block, we need to see a fair value gap, often called as an imbalance, right above the order block. So if we look here at the sequence of these multiple candles, as I said, the order block is the candle before the impulse. Now if we check that candle's wick, and we look at the candle next to the one that did the impulse, so this one, if we look at this lower wick, and we connect wicks, we can see a blank or empty space. That is called an imbalance of price. Now this is very important, but be careful. So the first candle's wick must not align with the third candle's wick, else if that happens, that is not a valid imbalance. A valid imbalance is what's seen on the chart, which basically, as we said, it leaves a gap between price. Now we don't actually trade the fair value gap using this order block model, but the fair value gap is used as a validation point that increases the chances of the order block being held, because the logic of the gap is that it leaves an imbalance in price. Imbalance that at some point must get filled for the market to keep its efficiency. So by filling the gap while also having an order block below, it increases the quality of the order block. So instead, we look to trade the order block. On bullish markets, we want to trade the order blocks with buy long orders. So let's position the order. Stop loss below the zone. Take profit around the last swing highs. And that's the simplest way to trade order blocks. However, there are multiple ways that we will soon talk about. But in the simplest form, this is what often happens, which is price filling the fair value gap, then moving towards mitigation of the order block, from where the price has a volatile and reactionary move to the upside from the order block. Here we have even the first downside candle that showed increased volume, just to fill the inefficiencies and reverse the price to the opposite way. So basically a sort of manipulation move to take out liquidity and move the market to the opposite side of the first downside reaction. Now, what we talked about was the order block in case of a bullish market. Now, during a bearish market, it has a similar process, just everything reversed. So we look at this chart at the most recent candles. We can see the first large volume candle. So the candle before that large candle is the order block candle. It is also very important to observe the fair value gap, which on the downtrend scenario, when we are looking for a continuation of the downside, the fair value gap is most often met between the order block's candle and the candle next to the large one. And when we are looking to take the market into downside action, the gap is taken from first candle's lower wick, connected with upper wick of the next candle from the large one, which is this candle, and it should leave a blank or empty space of price action in between these wicks. And now we can look to trade the order block into a sell short position. Entry right on the bottom, stop loss around above the order block, which also coincides being above the recent highs from the past consolidation, and take profit below the recent lows. And that's the simplest form of trading bearish order blocks. Now we know how to identify order blocks on both sides, be it bullish order blocks and bearish order blocks, and as well as how to trade them. But so far we learned the basics. The basics are good enough to understand the setups and create a plan around it. But the basics are not enough to increase the quality of the setup in a way that we understand which order blocks are more likely to respect. Because keep in mind, even if these concepts work, they will not work all the time. Not even if we master them, we will not be able to identify each and every order block as a valid. However, the goal is to increase the probability. So keep in mind, trading itself is about probability, and not about certainty. So there are multiple ways to identify high-quality order blocks. The first and most important one is that need to respect the high time frame trend. I tell you that because I've seen many times traders trading bearish order blocks when the market is following a clear uptrend, or trading bullish order blocks when the market is following a downtrend. This is a huge mistake, and they know that it's a mistake. However, they fail to understand the macro or external trend, and instead, they look into an internal trend and find an order block there that does not follow the macro trend, leading them to losing trades. So the way to avoid that is to always be mindful of the high time frame trend. So we choose one time frame as our high time frame. Then we start analyzing if we see a market structure that looks like this, making higher highs and higher lows, with bullish breaks of structures that show the continuation of the trend. Then we shouldn't be looking at bearish order blocks, but we should be looking at bullish order blocks instead. So that was the first and most important detail. The other important factor is for the order block to be followed by a break of structure towards the main trend. This is what actually validates the order block because it shows a continuation of the price action. So if we have here a bullish order block and the price break structure before filling the order block, that is what validates a higher quality potential setup. So if the market comes back down into the block, we can look to take the price higher with a buy-long setup. However, if the market pushes above into a new break of structure, without filling the last order block no longer becomes valid, and instead, we should be looking at the order block near the closest break of structure. Another important factor is obviously the fair value gap being present, as I said in the first minutes of the video, and the final one is not crucial to observe, but understanding it and seeing it will help. And that is about being able to identify a liquidity sweep towards the downside near the order block. The liquidity sweep is most often met by the price quickly wicking down the lows, and then instantly reversing back to the upside. If you see a similar move near order blocks, it is likely that the order block will hold and respect. And before jumping into the charts, we need to understand very well how it works for the bearish order blocks too. So mostly the same rules and factors apply just to the other side, kind of reversed. So if we choose one high time frame to focus on, and we see that the market follows a clear downtrend characteristic of lower highs and lower lows, these formations constantly being formed in the swing levels, then we need to know a very important thing. We do not focus on bullish order blocks, and instead we focus on bearish order blocks. We also need to understand the importance of the break of structure, but this time, the bearish break of structure. So on downtrends, the bearish break of structure validates a higher quality bearish order block. So on downtrends, after the bearish break of structure, we usually have a pullback to the upside. This pullback is also the move to most likely fill the bearish order block into taking the price into new lows. But if the market, after the pullback, if it doesn't fill the order block, and instead it breaks into new lows forming a new break of structure, this makes the last order block lose its validation, and instead, we should be looking at the probably new formed order block if there is one. And also one rule is the presence of the bearish fair value gap near the bearish order block. This one we talked about earlier in the video, and the last one is the liquidity sweep. The liquidity sweep in this case is also met near the bearish order block, but it's met from a candle that wicks up to the upside, taking the recent highs and quickly reversing back down. So remember, on uptrends, the wick was to the downside, and on downtrends, the wick is met to the upside. Now we apply everything that we learn into backtests on the chart. So at the first view of this market, we can easily see it was just a straight, aggressive movement to the upside. Pretty clear uptrend, I'd say so. That is, if we look on the external structure, and if we look into the internal price action, we see a similar direction of the trend. So here we got a swing high, then the market continued into a new higher high, and another high, and so on. Now on swing low levels, we can also simply observe how the market forms swing lows that are higher than previous ones. Most of them, if not all. So basically, we just confirmed visually the trend that the market follows. Now the validation itself in uptrends, it comes from bullish breaks of structure, and we meet multiple breaks of structure. The first one happens after the price breaks the last highs, then breaks again the last highs, forming another bullish break of structure. Then again, another one shortly after, and the last one is the most important one right here, because it's the closest to the most recent price movement. Now the question becomes, what is the candle that caused all of this aggressive bullish movement? And the same candle has the liquidity sweep rule that we've talked about earlier. Look at this wick. This downside wick takes out most of the liquidity from above, basically stopping out traders from these lows, and also creating a sense of false confidence for traders believing that the market breaks into a downtrend. But we can see what happened right after. The market just took stop-loss liquidity it pushed against the stopped-out traders to the opposite direction of the wick, and by also applying the order block theory. On validated uptrends, we look for the last candle before the impulse to the upside, which is this candle. So this candle represents the bullish order block. Another important factor is being capable of identifying if there is a fair value gap above the order block. And there is one right here. The fair value gap can also be traded in other strategies. However, when planning order block, we use fair value gaps only as extra validation to find better quality order blocks with essentially higher chances to hold. Now that we have all rules checked, we can finally look to plan the position itself, which on bullish order blocks is placing a buy long at the top of the order block, with stop loss below the order block, and the take profit can also be above the swing highs. But if the risk to reward ratio is way too high, I would not take it. I usually look for 1 to 3 setups, even 1 to 4 more or less, but not too far away. And now let's play the backtest. So right at this level, we've entered the position. And we can see the almost immediate reaction, and thankfully reactionary in the advantage of the position. And this closed with a win. Also, if we look at the market structure this move has created, it broke out the last internal swing highs, forming a bullish internal market structure shift. Now what I would look for is a continuation of the low time frame uptrend to move towards new swing highs externally, but we won't take that trade. One setup per structure is enough. It's important to not be too greedy. So let's practice more to get used to it, going into another backtest. Let's first start by analyzing the swing levels. So the first one is a swing high. Then the next swing high is lower than the previous swing high. That means that the market formed a lower high. And now let's take a look at the swing lows. The first one started from this candle, forming a local swing low. Then the next swing low is situated lower than the previous swing low. That means that we got a lower low formation. So a lower high with a lower low formation is the price action structure of the downtrend into the next rule, which is marking and analyzing the bearish breaks of structure, and not the bullish breaks of structure because it makes no sense looking for that in downtrend. So we got one break there. Now we can check that there is a bearish order block right here, being the last candle before the larger impulse that broke down the structure, and there is also a bearish fair value that leaves an empty price action in between these levels. But then remember what I often mention. After a break of structure, most of the times it comes a pullback. In this case, the pullback being to the upside. And the problem here is that the pullback did not manage to fill the fair value gap, and instead, it moved into new lows. So basically, there is another bearish break of structure formed. Now the problem is that the upper order block becomes invalid because the market already moved on and formed another structure. So instead, we look for a bearish order block that is the closest to the recently formed break of structure, which is this bearish order block. And now it invalidates the one from above. We are also able to mark the inefficiency between candles. However, it doesn't look like the best gap. But it's fine. The problem is when there is no gap to be seen, that is when I will start considering to not take the trade. So let's take this setup. Sell short on the bottom of the order block area, stop loss around above the order block, and take profit below the lows, looking for a 1 to 3 risk to reward ratio. and closed as a win. It almost got stopped out. Very close. But also, look at how beautiful market structure plays out, with the new formations of swing lower highs and swing lower lows. Trading technically is mostly price action and market structure. There is no need to complicate it too much when simple things work. On this market, this is a price action that we call a consolidation or a sideways market. The price ranges between the swing highs and swing lows. Order block are untradeable in such market structure, but if we check the swing levels, the high is a resistance level, and the swing lows as support levels. Now, if we look at the most recent price action, we can see that the market broke out the resistance. Ideally, as retail traders know, after a resistance break, we get a formation of an uptrend. But actually, most of the times, this will not happen. Most of the times, what actually happens is that the first break is a liquidity sweep. So in this case, after forming that swing high above the resistance, the market pulled back to flip the resistance into a support, but it managed to form a new swing high. And instead, it formed a lower high. So if we actually look closely at the swing levels of this whole recent price action, the high that breaks up, a pullback to the downside, a push to the upside that sets a lower high, then a break of the lows, essentially forming lower lows. So if we look at this structure formation, you should be able to recognize this as a downtrend bearish market. A bearish market with constant swing lower highs and constant swing lower lows. So now moving into the most recent price action where we look to plan the setup, by now you should have some skills to identify the order block. Now some probably ask that this is not an order block, and that's true, this is not an order block. Some traders notice an impulsive move and instantly consider the candle before that as a valid order block. The problem here is that this level is not on the external or swing levels where order blocks are actually situated. So if we draw the swing levels, this is not where an order block is found, but rather the order blocks are found near the swing levels. The actual valid order block is met right here, and we also have the fair value gap right here as an extra validation of the order block area. And it's now when we position the setup, so sell short at the order block. Stop loss above the order block, with take profit below the last swing lows. Here we can place below the swing levels, especially because of the great risk to reward ratio, which is about 1 to 3, closer to 1 to 4. The inefficiency got filled, so let's see if it goes into the order block. And yes, it did. Soon after filling the order block, the price rejected to the downside almost instantly. That's why I said price most of the times has a very aggressive reaction from the order blocks if you are able to identify high-quality ones. Let's move into one final backtest. In this one, we will apply everything we've learned in this video. So on this market, we can see that it started with a first upside movement, which is later followed by pullback to the downside. The pullback ends higher than the previous swing lows. So we got a higher low formation, which is then shortly followed by another upside push that breaks above the highs, forming new higher highs. So that means that we've got a bullish break of structure right here. Now pay attention to what happened next, after forming the higher high. The market initiated another pullback to the downside. Then it tried to push back up into new highs. So basically, it wanted to continue the uptrend price action that we've got so far. But it did not manage to break into new highs at this point in time, and instead crashed into new lows, a large bearish move towards new lows. If we look closely, the wick liquidated the past swing lows. But here it comes, the important part. The market instantly reversed back up after the liquidation wick. The market trapped traders into thinking the trend is going to reverse into a downtrend, but instead it liquidated their stop orders and continued the uptrend. Now we know this was a liquidity sweep, because the market did not reverse. A great way to not get trapped into these sweeps is to be patient and not overreact and take positions right away. The continued uptrend obviously formed new highs. That means that it broke the last highs. So we got another bullish break of structure right here. Now we are on the most recent price action, and because we validated an uptrend, we look towards the market forming a higher low. We just don't know where it could buy anywhere. But what's important is for the price to not move below the last swing lows, because that could indicate a potential reversal. And after the formation of higher lows, we look to plan by long setups to take the market into new higher highs. basically just following the trend. Now that we've done the market analysis, we can look for order blocks to trade. The most recent one is met right here, and it also has a price inefficiency between these levels. So let's play the price to move into the next steps. The price actually has managed to fill the inefficiency created by the gap, and shortly after, by the next candle, it wicked down into the order block, and instantly reversed back up. So one way to refine the entry and make it more complex but higher quality is to zoom into a lower time frame right when the price has filled the order block. So we moved into the 15-minute time frame, right when the price has filled the order block and bounced to the upside. If we carefully analyze the market structure, we see that the move was initiated from a low time frame downtrend, then a pullback to the upside, and now very important, instead of breaking into new lows to continue the downtrend, the market has pushed up into new low time frame highs. This is market structure shift that shows a likelihood of this low time frame downtrend reversing into a low time frame uptrend, to basically align with the high time frame trend, which is an uptrend too. And now the same logic applies as our last trades. We are able to see here a fair value gap between these candles. The inefficiency validates the bullish order block from below the gap. And now we look to position the setup, entry on the order block. Stop loss might work better here if we place it below the lows. This follows a logic that in uptrend markets the price does not form lower lows, but it does form higher lows. So the last low is considered a protected low. And for the take profit, we can look towards the swing highs, essentially expecting a bullish break of structure towards the higher time frame trend. We discussed about the technical side of trading, which, as you've seen, it's not complicated. However, it's crucial to understand that without a proper psychology control and discipline, learning technicals becomes pointless. On the link in the description, I've built an ebook on how to stop destructive trading behaviors, and as well as more complex trading guides. If you liked the video, leave a like and feedback in the comments. Have a great trading session.